Welcome back, everyone, to another edition of Chicago's Legal Latte. Hi, everyone. I'm Jim Mitchell. And today we're going to kind of go to the headlines. We're going to talk about a timely topic. Everyone is looking both from a business and personal side at what the new legislation out of Washington may mean to them from a tax perspective. And we're going to have a good conversation about that today. Joining me from Lavelle Law is Stephen Migala, one of the shareholders there. Stephen's been with us many times on the podcast. And for the first time today, Ed Brooks joins us. He is from DHJJ Financial, CPAs and business advisor. So, Ed, great to meet you. And first of all, thanks for taking some time to join us today.
Thanks, Jim. Looking forward to talking about some of these significant changes.
Yeah, they are big. And Steve, I'll kind of turn to you first. So many headlines, so many discussions about this bill. Are we talking about something that impacts both individuals and corporations as kind of blanket coverage in that regard?
Yeah, the one Big Beautiful Bill Act has a lot of changes in it for both individuals as well as small and large businesses. Some significant changes, and I think a common theme that you'll see both during our discussion and in any of our resources that you'll find online is that really it's been kind of an extension or made permanent of kind of some of the existing rules. And to some extent, there's been some modifications of those as well.
That's a great point. In fact, I want to turn to Ed on that because Ed has dealt with the corporate side. Much of your career, I understand, is in manufacturing, distribution, industrial sectors, which are, we have a huge business base in this area in that regard. And in some of the work I've done in the past with people in your industry, I've focused on the R&D tax credits. And every year it's like, well, is it going to be there? Can we plan on it? Is it going to be made permanent? Hasn't been made permanent yet through this bill.
Yeah, so well, there's been big changes with it. So, touching on the business side, the R&D tax credit for me and for a lot of our client base, this is the biggest change. So the big issue on the R&D tax credit was really more on the R&D, the treatment of the expenses related to R&D. So for 22, 23, and 24, business owners have had to capitalize expenses related to R&D and then expense over a 5-year period. That has been in many cases, a real hardship for business owners, creating a lot of extra taxable income in the short term. The hope was that would get corrected in this bill, or fixed is the right word. And so it is fixed. Now there's some complexity there, but from 25 and on, businesses can now expense R&D related expenses as long as they're domestic. Most of our client base, a lot of the R&D expenses are wages for engineers, designers. And so now you can just expense those wages just like regular salary. So that's important. That's a nice benefit for business owners that have some R&D tax credits. The credit itself is still the same. It's just the expensing of the actual, expenses.
And one of the keys, I think, to the R&D tax credit has always been documentation, right? I mean, that's something you really have to have well prepared when they come to someone like you to put their taxes together.
Yeah, the documentation requirements still have not changed. What qualifies for the credit still is not changed. It's just, when the timing of the expense is changed from 5 years to, current year. So, and the other important thing that I kind of want to let people be aware of is this law allows the options for businesses to go back to 22, 23, 24, and potentially expense the unexpensed R&D.
Okay.
So businesses that are under 31 million have the option to amend 22, 23, and 24 and just expense whatever hasn't been expensed. And businesses over 31 million, considered larger businesses, will have the option to take unamortized R&D expenses and deduct them in 25, or make the election to split that expense into 25 and 26. So 2 things on that, and we probably got the big issues covered is you can now expense R&D expenses, and there are options on how you treat the prior year. And I don't want to get into that, gets pretty technical, so I won't get into it, but I will say you want to reach out to your tax advisor because there's a lot of planning. What I like to say is you're going to have to run the numbers. Does it make sense? Again, these are options, but you really can just let the amortization run on whatever you capitalized in prior years.
Well, I know another big thing is we, kind of get as many in here as we can here for any business is depreciation. And particularly, I think there's some changes for bonus depreciation. Can you kind of recap what we should know about any changes there?
Yeah, I think one of the key things, high level, we're going from what would have been 40% bonus depreciation on an asset cost to 100% as of January, after January 19th. So after January 19th, generally equipment, assets a company buys can now qualify for 100% tax deduction versus 40. The other key thing that we think is important as tax advisors is it's now made permanent. So bonus depreciation has always been a temporary thing subject to phase outs. Right now it's permanent. Okay. So as a company is looking for planning and they now have a little bit of certainty on what the rules are going to be going out for at least the next few years. So that's a big part of the depreciation. The other issue is Section 179, which is like bonus, but it is different. But that was increased as well. The limit for expensing equipment under 179 was $1,250,000. It is now doubled to $2,500,000. Subject to some phase outs, it's still a really nice tool, particularly as you relate to the state of Illinois. Illinois allows 179 expensing. Illinois adds back bonus and spreads it out over time. So this is, again, another great advantage for business owners, a nice tax benefit. It'll also need some analysis, but we've got some certainty on what that rule is going to be, and that's very important.
Well, and as you said,
can I jump in, Jim, real quick?
Yeah, please.
So I was going to say just on the bonus depreciation, the breadth of property that it covers is pretty broad, right? It includes property with class life of 20 years or less, generally. So it's a pretty broad category of property that the bonus rules apply to.
Yeah, Steve, that's a great point to just. Yeah, it's a broad category, generally not related to what you would call your building envelope and real estate, but there's a lot of pieces within real estate that'll qualify for that. One quick thing that just kind of came up in our research in the last day is it does look like qualified production facilities, if under new construction, could be eligible for bonus depreciation. So we're talking about possibly expensing a new building if it is. Now it's got to be, I believe, new construction. This is pretty new. We don't have a lot of details on it, but if someone is looking to construct a new building, there could be some great tax incentives if that building is intended for production.
It's got to be placed in service here in the U.S. It's got to be used in qualified production activity. What it does not include, from my research, was leased property. So, a lot of businesses lease a property, don't own it. So it doesn't include leased property, and it doesn't include property that's used for non-production purposes. So, like a sales office or something like that. So.
Right. Yeah, good point. But something to keep your eye on, and really another nice incentive for investment in the U.S.
Well, as you mentioned, Ed, a lot of this, you're kind of skimming the surface. Some of it is new. You're getting your research done. One of the things we want people to do is give you a call to kind of talk through some of these issues. Why don't you share our phone number? First of all, we'll do it now and do it again at the end, but best place to get a hold of you if they want to have a conversation.
Yeah, certainly reach out. Happy to answer questions, provide some guidance. My direct line is 524-9701.
And then Steve, I want to bring you in because I know, first of all, you and the team at Lavelle are just great at putting content out. And I assume you've got some articles and other newsletters coming out that are going to cover some of these things.
Yeah, we're going to have an article coming out next day or so regarding just kind of a quick summary of the act and what we think are the important provisions. So it'll kind of tag team with this podcast. So we can watch for that on our website, lavellelaw.com.
Yeah, great place for content, and your team does a great job getting that out to people. Now, I want to bring you in, Steve, talk a little bit here about the individual side of what might be taken, individual taxpayers. And I know, I guess one of the big things is some changes in the SALT deduction. Can you kind of walk us through, first of all, remind people what that is and what's taking place?
Sure. SALT is an acronym for the state and local tax deduction. And before the act, it was capped at $10,000 a year. Now, with the act, it's going to increase to $40,000, and there's going to be a 1% increase every year thereafter. But it's going to revert back to $10,000 in 2030. In addition to that, there's a phase out of that additional $30,000 from the 10 to 40 bump for this year. There's going to be a phase out. It's for those with a modified adjusted gross income over threshold amount, which initially for this year is $500,000. So if you make more than that MAGI over that $500,000, that $40,000 SALT deduction is going to get reduced, and it's going to be reduced by 30% of that excess of your MAGI over the $500,000 threshold amount. But regardless of that kind of reduction, there's at least a minimum SALT deduction of $10,000. So worst case, you'll be no worse off than you were last year with respect to the SALT deduction. It'll still be $10,000.
And Steve, on the SALT, I did want to add, we were really happy to see what we call the pass-through entity tax deduction survive in the tax bill. There was a lot of talk about how that would be handled. And what that is, it is the ability of a company for a flow-through S-Corp, LLC partnership to pay the state income tax at the business entity level, generating a very beneficial federal tax deduction for these business-related state income taxes. So that was big, and we thought we might lose it or it could be limited. It is unchanged and remains as a nice benefit for our business owners.
Yeah, Illinois has that PTET, we call it, and so all the Illinois businesses can continue to utilize it. And just Illinois being a high tax state, this is a big issue for its citizens. So.
Yep.
Steve, one other thing, we've got just a few minutes left. I really want to talk about is this seems to just bounce back and forth so much, and your the state planning group at Lavelle Law has been very active and very informative. But what's going on with the state taxes? Anything touched in this bill?
Yeah, what it does, it gives our state planners some certainty and our clients some certainty regarding the federal gift and estate tax exemption amount. Before the passage of the bill, where this year was the exemption amount was $13,990,000. What the new bill does, it increases that to $15 million or $30 million if you're filing jointly. And so that's going to be indexed for inflation every year. So you'll see that amount go up every year. But it does provide some certainty with respect to federal state tax planning. Keep in mind, though, that if you are Illinois residents, the Illinois state tax remains unchanged. It's $4 million. It's not coupled. So you really need to continue to do your state tax planning, and a lot of our clients have to do that planning for Illinois state taxes at the very least.
Yeah. And Ed had mentioned the 179 expense energy efficient focus for corporations. On the individual side, I know there's been talk about clean energy credits for vehicles. Where do we land?
Yeah, so a lot of the changes in the One Big Beautiful Bill Act are not really Green New Deal friendly. A lot of them are trying to kill off those Green New Deal provisions either by accelerating them or phasing out. And so the one thing I really want to point out to the listeners is, if you're in the market for a new or used clean vehicle, electric vehicle, that you should really try to accelerate those purchases now, because those credits are going to stop for any vehicle purchased after September 20th of this year.
All right. And Steve, let's, like I gave Ed the opportunity, what's the best number or way to reach you to talk about any of these issues, either for a business or individual?
Yeah, probably the best way to reach me is really just through our firm's main number. You always get somebody live, and they can either track me down or throw you in the voicemail and I'll return your call. But it's always good to get somebody live, I think. So just 847-705-7555.
All right. So one last question for each of you. Same question, Ed, if you'd answer from the corporate side, and Steve from the individual taxpayer side. But sometimes with these bills, there's these changes and provisions, but they may not take effect now. It may be a few years out. Ed, on the business side, is this all happening now, or are there phase-ins? These might not occur for a couple of years.
Yeah, so on the business side, for the most part, this is all effective for 2025.
Okay.
So there's not, other than that R&D thing I kind of touched on, it's really just for 2025. And the nice thing I know all the planners like is we've got some certainty, so we can start, versus the uncertainty of expiring provisions. Most of this stuff on the business side is pretty permanent, and we can do some planning with it.
Yeah, that's
Steve,
the same
thing?
That's the same for the individual side. I mentioned that at the beginning of our conversation is, a lot of these expiring provisions were, essentially made permanent. Maybe there's some tweaks to them, but there's a lot more permanency with respect to these tax provisions, and just really helps us do our tax planning.
Yeah.
Well, both of you guys, great conversation today. Thanks so much for being here. Ed Brooks of DHJJ Financial. And again, Ed can be reached at 630-524-9701. Ed, thanks so much for being with us. And Stephen Migala, who we always enjoy speaking with, from Lavelle Law, 847-705-7555. Guys, have a great day. Thanks so much for being a part of it.